Hey everyone, it's Ben here, and we're going to be going over an Apple DCF today. And here's the agenda, pretty similar to what we've been doing in the past. Apple situation, I'll talk about Wall Street prep. Then I'm going to do a revenue build, and then build out the DCF, which will include things like calendarization, WACC calculation, and mid-year convention. And then we'll discuss the model a little bit. But first, let's talk about what's been happening with Apple. So let me pull up their most recent stock price chart. Okay, so over the past year, Apple's been down around 10%, which is actually not too bad considering how much the market has come down. Over the past year, it's actually up 11%. And Apple's been just like pretty solid and steady over the past, I don't know, forever, actually, to be honest, past like 10 to 20 years. Most valuable company in the world, and the question is pretty much, how much more value is there in the future? And that's what we're going to try to understand more today. And most recently, so usually I try to do my DCFs before earnings so I can like kind of see if like it could be a good buy or not before the earnings. But I got really tired yesterday and I fell asleep. And I was actually supposed to do this stream earlier too, but then I got really tired and so I took a nap. So I'm doing it pretty late. Usually I do my streams early in the morning when the market's like just opened. But anyway, Apple reported earnings earlier yesterday after the close, and there's a bunch of numbers that they report. I think the most important ones though is the iPhone revenue, because iPhone is just the biggest cash cow and money driver for Apple. And then also services. So we'll talk about this in a bit, but Apple is actually moving much more towards being a recurring revenue type business, like a lot of like SaaS companies. So that was Apple. Shares popped 4% after earnings yesterday because it was seen as like a pretty good quarter. And I'm not going to go through everything here, but there's like an earnings transcript I recommend that you guys read if you guys want to really learn more about what's been happening. So yeah, the phrase that's been kind of used is Apple has its Top Gun moment. And basically it just kind of just means that I actually didn't watch Top Gun, but it sounds like while there's a lot of chaos happening, Tom Cruise maybe is able to like execute really well in like this challenging environment. And that's pretty much what people are saying about Apple, because in this challenging macro environment, it was able to have like pretty solid, a pretty solid quarter. And so going into the bull case for Apple and then the bear case, these are, three of each for many out of many reasons for either, right? Because Apple's such a large company, there's so much to it than just these three things. But in my view, three important things for the bull case is first is if Apple is able to successfully move from maximizing hardware shipments to maximizing installed user base monetization. So what this means is over the past maybe 10 to 20 years, Apple was much more focused on selling as many iPhones, Macs, laptops, iPads, all that stuff, right? And that was their like core focus. But now with things like iCloud, and actually they have so much stuff, I don't even know like what it all is, but like app store stuff, like all these things that are recurring revenue and are ways for Apple to maximize their user base monetization. Like that's where Apple's really focusing a lot of their efforts lately, and where the whole growth story really is for the company. And you can see that here. Services revenue from Street expected 17.5 billion, and then Apple actually reported 19.6 billion. And we'll see later that this is their biggest growth driver as well. So that's super important. Second is Apple's main moneymaker, the iPhone, which I mentioned earlier. If it's able to see consistent, resilient demand and trend towards higher end models, because Apple more recently released cheaper models, then that will be a huge driver for Apple's growth as well. And the company is also releasing the iPhone 14 soon. So I'm actually planning to get that. And if that continues to do well and people are not keeping their old phones because they're just like getting better and better, then that'll be a good for Apple stock as well. And then lastly, long-term investments in augmented reality, payments, health, autos, home all pay off. And this all basically makes it more harder to leave the Apple ecosystem. That will all make things, that will all be bullish for Apple. And then if we go to the bear case, if there are more component shortages and China lockdowns, if they last longer than expected and disrupts supply chain, since most of Apple's production happens in China, that'll be a huge, or that'll be, I don't think it'll be like the end, like a long-term issue per se, but it is something in the short run that will be bearish for the company. And then consumer demand weakens with the tough macro environment. If there's like a recession, a severe recession that comes about, then, you know, I do think Apple, because the products are just like, the brand is so strong and the products are so useful, I don't know if Apple definitely will get hit, but it may not get hit as much as other like kind of lesser quality product driven companies. But we'll have to see about that. With that said, of course, if with more macro issues, the guidance that companies give will miss, right? And so earnings may come down and stocks may come down for that reason. And then if there's greater competition in key outside US markets like China and India, where there are a lot of really cheaper options, and those companies in those countries know how to really cater to what the customer wants. And that could be like a key issue for Apple as it tries to grow outside the US. And then if there's increased regulation, particularly around the App Store, then that could be an issue as well. So those are kind of the high level things I wanted to call out about the bull case and bear case for Apple. Let me know in the chat if you guys have anything else, and I'm sure as people are reading the chat and stuff, it'd be helpful to get everyone's input, not just my own, because, you know, I'm just one person and I don't know everything. But as few friendly reminders, this is going to be a high-level street-based DCF for educational purposes. So please don't just use what I have here and then just like make your own financial decisions based on it. Just use it as one piece of many other parts of your research. And then second, I do have an Excel shortcut video and DCF tutorial videos that are down in the description. Feel free to check those out if you want to learn more, because I'm not really going to go through a lot of the basics for Excel or DCFs as I go through this video. And then lastly, if you want access to this model, it's available to the terabyte tier on Patreon, but I'm actually going to, starting next month, change it so that these models are available for anyone in the Gigabyte Patreon, which is $20 a month. So I just wanted to make the models more accessible to everyone. So that'll be happening starting next month for the models starting August onwards. So anything before August will only be available to previous Terabyte patrons, and then everything August onwards will be available to Gigabyte patrons. And I'm also creating a how to get into banking course. Feel free to sign up using my link in the description. I'll be giving a huge discount to people who sign up early. And I also have some guides of like my resume and cover letter that got me into banking, and like an industry guide and stuff if you want to check out rareliquidcareers.com. That's actually kind of a good segue into the sponsor for today's video. If you guys have been following, you guys know I work with Wall Street Prep, and there have been some questions about like my course versus Wall Street Prep and how those two might conflict. And they're actually going to be very complementary, because my course is going to be more of how to network, resume cover letter, tips, industry overview, behaviorals, and then how to strategically plan and study for technicals. Whereas Wall Street Prep will be much more in-depth, focus on technicals, right? So they're a company, just to go in them a little bit, they've been around since 2004, and they work with a lot of the top banks and institutions in order to train people for like financial modeling. And I'm getting my MBA at Wharton right now. I just got an email last week saying that I have access to all these Wall Street Prep courses if I want to get better at financial modeling. But they have all these courses here. So this premium package modeling is their most popular, and in here I'll go through it later. But they also have a bunch of other stuff, and if you use my code RareLiquid, you can get 20% off of any course. So feel free to check them out. I do recommend this accounting course if you don't have any like foundational knowledge about finance, because this is really what you need to know first before diving into modeling. And then this financial valuation course, it goes over financial statement modeling, DCF modeling, M&A, trading comps, transaction comps, and LBOs. And this, if you are recruiting for banking, or even if you're about to like start banking and have some time, all this stuff is super, super helpful in being ready for interviews and the actual job. And there's like, let's see, like 100,000 students who took this course. So it's pretty, and 46 hours worth of classes. So yeah, super, super helpful stuff. If you're interested in banking, feel free to check them out using my link. And now let's go to the DCF. So we're going to start off with the revenue build, and I'm going to do my best to make it as detailed as possible, but we'll kind of see how things play out. So I gathered a bunch of data from FactSet. And let me zoom in to all of these so you guys can see everything. And I will try to respond to questions and stuff in the chat as much as possible. All right. So let's start off with the ticker and then the date. And as I do this, I'll try to talk about something kind of totally unrelated, but there was a question that asked about it in the chat about my current thoughts on the crypto markets. And my thoughts right now is that there's been a recent increase in the prices for crypto, right? And there's a lot of, it's a little unclear, or a lot of people are not super clear why, but I actually think it's mainly just that there's been a huge drainage of liquidity in the crypto markets because of all the bankruptcies and the stuff with Terra, 3AC, Celsius. Like all these things have caused people to really just drain all their money outside of the crypto markets, right? And then now that actually can create a tailwind as well, where because so much has been drained out, all the weak hands or whatever, are out, and then things are so low that momentum starts to pick up on the other way. And so that's kind of what I think we're seeing. People are, Ethereum, for example, fell to 1,000, and I think that's the point at which a lot of people felt that was like low enough, and now it's kind of rebounding, and people are like kind of getting FOMO-ish. But I think it's still a very murky picture over the next 6 months. There's still potential for a recession, which will affect both the stock and crypto markets, and we could go lower than the previous low we had recently. So it's my rough thoughts. But going back to this, so I think revenue build will. Let me just look at the information here. So the reason I'm going to go through calendarization later today is because Apple has their fiscal year end in September, and we want everything to be as of the calendar year end of December, because it's just kind of cleaner that way. But okay, so we have units and selling price, and then so we have units, average selling price, and then product segments. So we're going to kind of combine a lot of these together. All right, so these are their 4 main products. So iPad, I'll actually start with the iPhone. Let's see what's the largest. Then it might be iPad, Mac, and then Apple Watch. Okay, so let's see. There's going to be units, and then there's also going to be selling price. So we're going to sensitize for both. So this is kind of going to be a more detailed revenue build than the one we did for Microsoft. All right. So wow, this is actually going to be a little bit more detailed. I'm gonna try to finish this stream in 2 hours, but we'll see. Might be a little longer than that. While I'm doing this, I'm curious to know where you guys are all from. Let me know in the chats what country you guys are from. All right, so we're gonna just keep building. I'm just gonna keep copy pasting this stuff down. Wow, a lot of European. I'm surprised that someone from Korea is here because I'm actually in Korea too. It's pretty late or early in the morning. So question, will this model account for the buybacks Apple does each year? It's a great question, and I'm gonna say no because I think that'll be a bit beyond the scope. Maybe something I could add. I'm gonna try to do models for companies like every year or so. So maybe that's something I can look into and then try to incorporate later in that next model, basically. Okay, so this is gonna be as of fiscal year end. We're gonna need to calendarize later. All right, so let me, by the way, I'm doing a lot of this on the fly here. So there's gonna be times where I might, struggle a little bit here and there. But I will do my best as we go through all this. Okay. So we are gonna need switches for the iPhone units. There's gonna be a lot of switches. Yeah, our buyback's relatively easy to model. To be honest, I have not ever needed to model in buybacks for a DCF. I think, but I think I'll put it as a goal for my next Apple model to look into it because I'm sure I can figure it out. So, I'll let you guys know in that next model, I guess. So, revenue build switches. So also I'm building out a lot of this like revenue build stuff in order to, honestly, it's more for educational purposes. I don't know exactly how useful it's going to be. I may end up really just using, wait, hold on. I may just end up using the street case. So we'll see. Okay, so we have our switches here. So just I'm gonna have this as a reminder. So 1 is conservative case, 2 equals base slash street case, and 3 equals optimistic case. All right, so let's see. We can at least first link to our historicals. So units for the iPhone 169. So this was for the iPad. For the Mac. And then this is for the Apple Watch. Okay, and then for color coding, as I've mentioned in previous streams, this will be green. And green is for when you link to another sheet. And then we'll get the average selling price. Oops. Okay. So for some reason, we don't have information for 2014 for everything. So I'm just going to start with 2015. I don't think we need to go back much further than that anyway. Okay, so I also realized we're going to need here iPhone revenue. And then we're going to need growth, percent growth. So this will be selling price, units in millions. Okay, so these are all in millions. So that's about $102 billion. Okay. So right now I'm just getting everything set up. We're gonna start like building out the assumptions and stuff in a bit. Yeah, really just getting everything set up right now. Whoa. This is actually kind of reminding me of my the biotech models I used to build, because revenue builds were such a big important part of building out biotech models. And we used to project out models for 15, 20 years. And I haven't yet, while for streams yet, built out revenue builds this detailed, even though this is not really that detailed in the grand scheme of things. Okay, so we have iPad, Mac. Weird. Okay, I see a question. Do you use enterprise value in your model? That is eventually what we're going to build towards. Yes. Okay, so let me just double check that everything is in the right column. So, all right, this is in D. This is in C. That's weird. Okay, what did I do? 2015. Yeah, when I changed the date, I didn't change everything, so well, that's why I guess it's important to double check though. So I asked this question in the previous stream, but I'm wondering what you guys watch these models for, or these videos. So, and I'm sure it's different for each video. So are you guys here to because you guys are like investors? Are you guys students? Or just, you know, somehow the algorithm led you here and you're not really interested in modeling or investing, but you're just here? Average selling price for the watch. All right. And then something I need to mark here is that 2022, starting in 2021, these numbers are actually all estimates, at least for the fiscal year. These numbers here are, these are all estimates for the next, and we want it for, we were probably going to do a 10-year DCF or either a 10 or 5-year DCF. We'll see. Oh, we got a FIG banker. Oh, interesting. Some of you guys are students. Corporate lawyer. Wow. That's some pretty smart people in here. Also, I'm sure... never mind. Okay. Okay, so we have the basics down here. And now I need to think a little bit about what I'm going to do. Okay, so I actually realized one thing is missing. We need growth rates. That's really what we're going to be building everything off of. Okay. Wow, this is gonna take longer than I thought it would. But you know, I think Apple is one of the most interesting, largest companies in the world. So, you know, this will be on YouTube probably like forever. So, I don't know if this will be something people look at years from now, but hopefully it's helpful for the time, for more than just these next few months or whatever. Okay. Let's calculate the historical growth here. Okay, so now we have to I have to think a little bit about how I'm gonna actually use this information to model things out. Because 2024, I was checking in FactSet earlier, which I'll show you guys right now. A lot of the estimates for 2024 are very bare. And so we can only really rely on 2022 and 2023. So these numbers are not going to be super, super helpful. I would actually probably just, let's see. Yeah, it's just one broker. So I'm just going to actually delete these. And then I need to start projecting out starting this year here. All right, so now we have the basics. I also need to get growth rates. So this is for the iPad. Okay. So I'm doing this here so that I can just link to these. I'll show you guys why I'm doing this in a bit. Okay. So our actual, for our 2022 and 2023 figures, we want to make everything dynamic in the model here, right? So I don't want to just link to them here because otherwise when I change these switches, it's not going to actually do anything. So I'm going to delete these here. But do you ever need to use the mouse for Excel? I try to avoid it as much as possible. Okay, so in our base case, that's pretty much what we want here, right? So let me actually reorganize this because we start with the iPhone first. Oops. All right. So I've explained this before, but usually when you have 2022 or when you're looking at estimates, analyst estimates, they tend to be pretty accurate for the year that you're in. So right now, we're in July, almost August of 2022, and there's only pretty much 1 month left that analysts need to project out. And actually, surprisingly, even for just having a month left, analysts are pretty variable as to what they expect. And then in 2023, usually things are a little bit more variable. But anyway, the point of that, me talking about that, is that for 2022 and largely for 2023, I think we can just stick with what the street believes is going to happen. And then we'll build out our scenarios based off of what else we see. Okay, so here, so sometimes I do need to use the mouse a little bit when things are a little bit more efficient to do so. Okay, so let me think here. iPhone units. This is going to be a little bit challenging to... Oh wait, I did that wrong. (2022) growth 2% then 1%. Average selling price. That's a funny question. Why did I quit IB just to play IB on my channel? That's a long story. I have a why I quit investment banking video, but honestly, this is, even though I am building a model on YouTube, doing it on YouTube versus not having like a good work-life balance and not really pursuing what I really want to do, which is like build a business. Because I do stream fairly often, more so now than I used to, but there's a lot more to building out Rare Liquid that you guys don't really see yet. So there's like a lot of different revenue streams, and like I hired some people. Like I have a team. All that stuff like would not be able to do in banking at all. So that's like a short version, I guess. Short reply. All right. So okay, now we're at a point where we can just finally start projecting. This is where things will be a little bit challenging. And I don't really have a ton of research that can help me project out super well for the next X amount of years. And so I think I'm trying to think about what would be best based on so we're looking at what I'm doing is looking at kind of like historicals, and then because you can kind of see like all these numbers have been fairly unpredictable. And yeah, like this for instance grows. Apple Watch grew pretty quickly because it was a new product, and then all of a sudden it fell for whatever reason. And then for the iPhone as well, especially when there are like new phones that come out, and there's also this huge mix of like different types of iPhones. There was like a huge growth that happened in 2021 for whatever reason. And now it's kind of back down to 2 to 1%, right? And so I think in a base case scenario, what would make sense to me is if Apple kind of maintains this like similar rate. Because see, the most that Apple has ever sold was 238 million iPhones, pretty much. That's actually a little bit optimistic to think that Apple will continue to sell that much throughout. So, let's see what the average of these three are. So 4% seems like kind of what the average was. In that case, like, yeah, let me see. 231, 212, 217. Right now in my head, I'm just thinking like 1% growth. Even that might be a little bit optimistic because you do have these kind of more down years. Man, this is. Okay, I think. Let me check one thing. Okay, interesting. So this one broker that does project out to 2024 does think that the units will come down. So I think we may have to do something where every few years we see like this decline, and then it kind of like goes back up a little bit. Usually 10. So there's like a pattern kind of ish. So it's like a 10% decline, and then like a small bump for a few years. Man, this is pretty tricky. I see something about industry growth. We could look at that, but I think this is like pretty much representative of the overall industry, right? And I do think that actually one thing that could drive more unit growth is, now that I think about it, more like outside US markets where the markets are not as saturated. And how can you predict growth so many years into the future? that is kind of the whole point of trying to do this. Actually, now that that actually brings up a great point. I don't think we need to do 10 years for a DCF. Probably just need to do 5 years. So let's see. So, and I was debating on that earlier, but thank you for bringing that up. I just realized it's probably better to do a 5-year DCF for Apple. And once we calendarize this, we're gonna have this. So we're gonna have 1, 2, 3, 4, 5. So it's probably better to do it this way. Actually, I'm gonna keep it 6 for now since we don't have. Well, actually, if we do mid-year convention, we might do 6 years. Might do 5, might do 6. 6 just because 2022. Nah, actually, let's just do 5. Sorry. Okay, but this is relieving a lot of my stress already because I was like, how am I going to predict this accurately for the next 10 years? But I think this is much more doable. So I think in the street case, we can just assume that the street kind of is accurate, right? It's going to grow by 2% down and then 1%. And then if things go as they have in the past, it seems like maybe every few years people just like the latest iPhone, and then so they kind of stop buying, or maybe there's some macroeconomic event that causes things to decline. I think for this, we can just take an average over the two big like declines that we have here, and then grow it again by 2 to 1%. I think that's like pretty conservative, like like a good base case. I think that's pretty reasonable. So we'll have a conservative case here, base case, an optimistic case. All right, so then we're gonna need iPhone 2024 units. Okay, and yeah, as I'm doing this, if you guys have any input, I'm more than happy to listen to your guys' comments and feedback because first of all, there's like some of you in here I know are really smart. And then second is yeah, I'm just one person, so always great to crowdsource knowledge from you guys as I do this. So this is gonna be a bit of a simplifying assumption here, but I'm going to be just assuming that we have a negative 11% decline here in one of the years. So Apple obviously is going to do everything in its power to avoid this, but it may not be avoidable. All right, so far what we've got is that we are going to just in this street base case go with what the street thinks is going to happen, and then have like this every 3 years kind of issue where Apple declines in terms of units, and then we're just going to kind of grow it back up in a kind of. So 11% question is, it's just an average of these two that we have had in the past, kind of just a simplifying assumption. Okay, and then for 25, 26, the only tricky thing here is that there was this huge growth here because I think mainly things have fallen so much, but let's see what our numbers come out to. But in this base case scenario, would be good here. So 24 units. So I see a good question of, can you use exponential smoothing for your assumptions? I don't think we will need to. or let me consider that. The thing is that right now, if we were trying to grow, like if I was going to look at the CAGR here, it would be, I would have to make a simplifying assumption there anyway too, right? Because if I were to do an exponential thing from here to here, it's pretty much going to just be 0% growth for the next 5 years. And then if I do it starting from here, it's like, why are you not starting from 2015? Why do you start from 2012? And that'll have like a maybe probably like 1 to 2% CAGR. And so I think ultimately we'll end up in a similar-ish spot where we have to make a simplifying assumption. And I think assuming that something happens every few years where there's a decent drop in iPhone sales, I think that's pretty reasonable based on what we've seen historically so far anyway. Okay, and then so for 2025, 2026, and by the way, always, you know, you guys can disagree with how I am like kind of doing things. And you guys will probably just need to build your own model to do it the way you guys want to. Okay. Let me see where this actually brings us. All right, so then what I'm going to do for the conservative case is just do a 90%. So for 2022 and 2023, I'm going to, since these numbers are not that, it's not like these numbers are that massive anyway, I'm just going to take what the street is giving us, since this is a street-based DCF. And then I'm going to make the other aspects a little different. So then 2024, I'm going to take a 110% increase because this is lower. It's making it a larger negative number. And then for the optimistic case, we'll make it 90%. And then for 25, 26, we'll make it 90%. And so we might, you know, change these a little bit, but the whole point of all this is just to have a range and make our model flexible. But when it actually comes to like looking at the implied share price and whatnot, I'm probably just going to honestly just use a street case. All right, so then let's see where these numbers get us and see if they look reasonable. All right, so what this shows is that we're gonna get to 244 million, 246. So those would be record years for Apple, and then we see a decrease down to 216, and then a steady like climb back up. So I think given that this is what the street thinks is gonna happen, I think this is not too out of the ordinary. Or I mean, sorry, it's not something that people are not expecting. The street expects Apple to get to these figures. And then a huge decline, you know, that's just kind of like an assumption baked into our model. But I do think that we will need to have more aggressive, optimistic, and conservative cases here. So something like 150%, and then optimistic case 50%. So go 205 versus 219 versus 232. Yeah, I think something like that is more necessary. Okay. And then we will now go to our average selling price. And we'll also have to think about what to do here. So the numbers here are also a little bit wonky. In general, it seems like things have been trending upwards. Let's actually see what in this scenario, I do think that given it's just mainly on the upward trend, a CAGR could be interesting here to use. So that is that divided by that to the power of the year. 1 divided by 26, I think it's 6. Oh, minus 1. This is a CAGR formula. I think this is correct. So this should mean that times 1 plus the CAGR. Oh, it's not correct. 21 minus... I'm forgetting my CAGR formula. So that plus 1 plus that, okay. Okay, I'm gonna have to look this up. Final over begin, divide by 1 over the, okay, so that's correct. There might be a CAGR formula, but I used to calculate it myself all the time, so I'm not really sure what I'm doing wrong. Oops. Oh, this is so weird. All right, anyway, it's around 2%, 2 to 3%. Okay, so let's think. So I see a comment, ASP will probably stay flat. Yeah, I don't think it's gonna go much more than this because Apple iPhone's more than $1,000 on average. I think it's gonna be pretty tough. So I think something that would be optimistic is if it increases by, like, I think this would be optimistic here, for example. Increase by 2% in the latter years. So let me... I'll slightly increase next year's to account for inflation. That's a good point. Although I think the other counter argument is that there could be cheaper options that start to sell more. And then, so yeah. Okay, but anyway, we're going to do the same thing as we did here. Go with the street case for next. It's really believing that the street is going to be correct for the next month and then the next year. So I think that's fine. And then in our base case, iPhone ASP, I think we're just going to use one flat number for everything. So for the base case, we'll just use an average. Oh, wait, no. Base case, we will, if it's at 0% and it's flat, well, because we want to be a little bit, we want to be a little bit conservative. The red color code means it's like a little bit different from the other, like something weird-ish is going on. Okay, so I think what makes sense here for me is based on seeing the optimistic case being 2%, then we'll have a 1% for our base case and then a 0% for our conservative case. All right, we made it. We did one part of our revenue build. Oh wow, that took a while. But after the revenue build, to be honest, like everything else is a lot easier, the entire DCF. So yeah, this revenue build is what we do want to focus the most time on, since I do think it's the most important. Okay, so then formula is that. Okay. Now we can just multiply this across. Purple formatting is when it's linked to something in the same sheet. I see a question. Is there any scenario where you use quarterly filing instead of the 10Ks? Yeah, definitely. Oh man, I hate when these spammers come. Let me ban this person. Oops. Okay, yeah, 10Ks are really helpful in general. I think for the modeling purpose, for our modeling purposes, I don't really look at them because I want to, because it would take a lot of time, basically. Okay, so maybe in the future though I will. All right, so something I want to compare against is we have estimates for what the street thinks sales is going to be for the next few years. So for the iPhone 2022, 204, is that million? Billion. 204. So 2022, 204, that's correct. 206, 185. Okay. So it looks like our estimates are a little bit more on the, definitely on the conservative side. So this 2024 figure is just one analyst. But again, like we're baking in something that the other analysts really are not. So this is our street case right now. And I think it's actually very, very conservative, almost too conservative. Like, I mean, the question is, do we think that Apple may see a considerable decline in this 1 year here? And how quickly would the company be able to rebound? Okay. Hmm. 10% decrease. This would be pretty massive. Wonder what happened here. 2019 Apple. Okay, slowing revenue primarily in China. Okay. So it seems like the iPhone fell because people were not upgrading. Honestly, for me, I'd rather be conservative. I think that could happen again with Apple. I don't see a reason why this, like, after a few years, iPhone's just getting better and better. I think it's a very likely scenario. So if anything, though, I would want to make this optimistic case a little bit more optimistic. So something like only a 3% decline. And for the conservative case, I think we're already building in a conservative case. So I think this does not need to be as conservative. So something like that, I think makes more sense to me. And I think what I'll do later as I look at the implied share price is I'll actually, not, instead of only using the street case, as I mentioned earlier, also you look at the optimistic case. Okay, so that's what I'm going to do there. And then now let's move on to the iPad. So pretty interesting here as well, where we saw decline for a bit and then an increase again, and pretty huge increases. And I think a lot of the narrative here was that during COVID, people shifted to the iPad, and then now it's maybe not as needed, so it's kind of more has declined. But let's at least for now do the same thing here, where we're just using street figures. Okay, and as I'm doing this, I'm realizing this is probably going to be a 3-hour long DCF. So props to anyone who actually watches through this whole thing as I go through all this. All right, so negative 6%, 0%. So it seems like generally pretty flat. And then if Apple were to maintain something close to being flat over the next few years, that seems like it would be a positive for Apple almost, because even if this decreases by 6%, that's like a, what is it? It's still in the 60 millions. And if it were to stay around 60 million, that might almost even be optimistic. So I think for our base case, what I want to do here, so let's write this out. So our base case, what I want to do is take an average of the past 2 years. And I'm not 100% sure if I'm going to stick to this, but I want to see what it looks like. And then for our optimistic case, we'll assume it stays flat. And then our conservative case, we'll have it 125% decline. Okay, so let's see what that gets us to. All right, so then what this is saying, I'm also gonna hide this so you guys can see. Okay, so then what this is saying is for the iPad, in our conservative case, it goes from 64 to 62, then 59, 57. I actually don't think that's really conservative enough, given that this has been like the best year for Apple so far. And we could see a decline as because the iPad may not really, it may only really improve marginally. Okay, so I think based on these numbers that I'm seeing here, I'm going to want to have a 150% decline for the conservative case. And although I do think that the iPad, may have kind of reached a peak in a sense in our, it is also possible that, this is the new normal, right? Like people increasingly more depend on iPads. And so this conservative case of it going down to 56 million over time, I think is okay. And then in our base case scenario, it's just like a steady decline, maybe a little bit optimistic, but then I think it's not too crazy because we're just assuming a 3% decline over time. Okay, so I'm okay with that. And then average selling price, Looks like it's been kind of flat-ish. So again, let's do the same thing here. All right, so it's been kind of actually been going up and down. I think what would make sense here is based on these figures, an optimistic case would probably be an average over the past few years, given it's been going up. Okay, and then I think a base case is that it just stays flat around 421, which would actually, it's kind of a little bit on the conservative side, given that 421 is almost the lowest it's been in Apple's history, but I think that's largely in part because Apple is introducing cheaper models. And then for conservative case, I think what we can do is have a negative, actually, let's see. I think our conservative case actually, given that this is the lowest it's ever been, should be, or one of the lowest, right? It's been 416 as well. I think our conservative case should actually be 0%, and then our base case can be 1.5%. Okay, so let's see where that gets us. Okay, so if we have everything in our base case, street case scenario, we will have iPad revenue of 28-ish billion. Let's see what it shows here. 29, 30, 30. So it seems like we're a bit too conservative. Let's see. Yeah, Apple growth rates are pretty small. Very interesting. I think our numbers are just our numbers are just being like they're just way too conservative. So these are for reference what the street thinks is going to happen. And even our most optimistic case is less than what the street thinks is going to happen. So that's kind of a problem. This is actually kind of weird because I'm just using street numbers here. I guess what this is saying though is that given that while things were on a decline, things have now been on, now things are kind of going back up. Given that things, maybe it's because things are kind of moving back to work from home, moving towards work from home. Maybe it's we're being too conservative and need to make our units here 0%, and then for our optimistic case, something like a 2% growth, and then for a conservative case, we can put in something like a negative 2% growth. That gets us closer. Let's see. Wow, that's still the optimistic case. In these years, we do want to get as close to the street as possible. So, I think what's going on is that the full revenue for the product line estimate is different than what the street thinks is estimating for the individual units prices and the selling prices. So that's why we have like these differences. This is pretty meaningful. Just trying to think about right now of how to get as close to the street figures as possible in our street case. We think we do need to not be so conservative. Although we're just using our street figures for the case here. I guess one thing we can do, while we do have the averages here. No, simplify. Okay. Okay, well, while the street does have these like figures here, I'm also just looking at the unit counts here as well. So right now in our base case, we're assuming that things stay flat at 64. And that just kind of means that it's going to be like this continued selling of 64 million is going to happen over the next 5 years. And things could decline meaningfully as it had in the past as well. So I think this is actually fine. And then the average selling price staying around 440 and growing to 464. 464 is more than the selling price has ever been in the past, right? So that in itself is already a little bit optimistic. So that, I think, even if we're less than what the street thinks, I think this is more realistic. So this will just be my, the model will be a little bit more on the conservative side, but that just means that if Apple's undervalued after doing all this, then it's even a better reason, even a stronger reason to buy Apple. All right, so now let's do the Mac. We're almost done with revenue build, and then we'll be able to build out the DCF for everyone. Okay, so Mac 2021 was, these years are just weird because of COVID. 8% growth, 2% growth. So seems like things might grow and then probably just like flatten out. So that's what I would assume here. So I think in a base case scenario, we would just make it. So let's see. Well, Mac units, Mac average selling price. So I think what we'll do for the Mac is have it at 0%, and then units for optimistic case, we'll make it equivalent to that. And then in a conservative case, we will grow it in a negative. Okay, so then oh, okay. All right. So offset Mac units switch 0. All right. So question here is about adjusting for inflation. Um, I think we do have in our prices here things growing near 2%. If we do believe that and also there's like these huge declines when new models are being introduced. So it's kind of hard to just really know what'll happen. I think these assumptions are reasonable enough. Okay, so now we have our Mac. I think this is a little bit more on the optimistic side if I had to guess, because it's the most that Apple has ever sold and it's kind of just like staying steady, right? So for this, I would probably more likely use our conservative case. Actually, it looks like our conservative case needs to be a little bit more conservative. Actually, it's been on the incline. Yeah, I think that makes more sense to me as a conservative case. Okay. Now for the average selling price, looks like it's been going down for the past 6 years. Increasing, I guess all these prices are increasing in 2022 because of inflation, and then it's expected to come back down. So I think our average selling price in our base case can just be our previous year. And then in 2024, and for the rest of the years, I think we can take, for our conservative case, we can take an average of the past 3 years of what's happened. And then for our optimistic case, it doesn't seem like it's going to ever really increase except for this year, right? So I think if we were being really optimistic, we'll just have it at 0%. Assume that things stay flat. Okay, so now we have our Mac revenue. Almost kind of done with revenue build. Oh, okay. Now we will need to get to our Apple Watch. So this is I think might be the trickiest because I see a question is why is oh yeah, great catch actually. This is not correct. The Mac is not linked correctly. It should be here. Great catch. Thank you. Now that you brought it up, that would have been very, very odd. Given that the Mac is much more expensive. So let's see what's happening here now actually. So we have 3%, we're doing the same years in 2023. Maybe we can use the same thing that we just built here though. So damn, these freaking spam bots. So in our base case scenario, like we would just be keeping it similar to what's been happening. Well, actually, no, it looks like in our base case, actually in our base case scenario, I think it does make sense to decrease it by 1% because if we were to take an average of these three, that would be probably like negative 2%. And that is what we have for our conservative case. I think that makes sense. And then an optimistic case, maybe grow it by 1%. So actually, let's just keep it flat at 0%. Then it's let's see. I think what makes more sense is 0%, 1%, and negative 2%. Units is number of units being sold. So if we're doing a revenue build right now for Apple, and revenue build is really just your units times your selling price. Okay, so Apple Watch. Okay, Apple Watch is next, and let me actually do a quick sanity check. So the Mac 2022 should be around this. And we are being a little bit conservative again. But I think that these numbers are reasonable. This assumes that Apple is going to increase its unit count and have it just be stable for the next 5 years, right? And we might see some dips and we might see some increases, and that might balance out over time. And then the unit selling price, we're assuming stays like pretty flat while it's been on like a kind of a decline-ish. So I think that's fair as well. So I think that's okay. The selling price here should actually be positive. Okay. So now let's go to the Apple Watch, which will be the hardest one to really predict because the Apple Watch is new and it's like a fast grower. So grew from 6 to 29 to 56 and 40. I think it fell because maybe people weren't using it as much during COVID. And it's interesting, the analysts think it's going to grow by 37% and then decrease down to 10%. So I think for our base case, this might be a little bit too conservative, but let's see. All right, so we have to figure out what to do here. I'm debating between just using an average of the 2 years, see what that would come out to. 23% growth. Pretty aggressive. I think that's what we would assume for the optimistic case scenario. It's not super far-fetched given, like, you know, if Apple is to be able to make the iWatch or the Apple Watch much more attractive and with like product tweaks or whatever, this is in the realm of possibility for sure. And then in a base case scenario, I think we would just do, so this is going to be a very simplifying assumption, right? But I think we'll just keep it flat because this is also really small. This is one of the smaller drivers of Apple's revenue anyway. And then for our base case, I think we can do just a 75%. Oops. 75% of that optimistic case. And then for our conservative case, we'll just assume that it stays flat at this current rate, the rate of 10%. So pretty simplifying assumptions, but I think it'll provide us a nice range, and we can always change. We can use whatever we feel like makes sense when we're looking at the implied share price at the end of this. And I think 18% growth, while the numbers are increasing, so it should be harder to grow, but I think this will also help account for when things go up or down a little bit. So we might have a year where things, maybe the watch grows by 40% and the next year it falls and only grows by like 5% or negative something percent, right? So while these numbers are flat and that's not what you normally want to see, you want to see like a trend towards something. I think these will also kind of capture the up and down movements. And we don't want to get too crazy with our assumptions given that we don't exactly know what's going to happen since it's a new product. So that's why we're going to do that one this way, or the way we did it. Selling price seems like it went up because of inflation, and then besides that has just been on a downward trend. So I think in our base case, we can just assume that that downward trend continues to happen. So for our selling price, we'll keep it consistent here. For our conservative case, what is this decrease? It's decreased by 1%. We'll just decrease it by 2%. And then our optimistic case, we'll keep it flat. Okay. Actually, I also need to sanity check a few things. Oh wait, let me do this. Let me finish this out first, actually. All right. Props to you guys, by the way, if you guys have been watching this whole thing, because it took a lot longer than expected to build this revenue build. And a lot of it was just like literally just me thinking out loud. So let me know in the chat if you've been around since the beginning, just out of my own personal curiosity. Okay, so one more sanity check with this. The Apple Watch revenue 2022. Huh. Seems like we're being super conservative. This is a problem. I feel like there's something going on here where maybe some part of the Apple Watch we're not taking into account in our revenue here. Or maybe the street just thinks that it's going to grow a lot more quickly than what I've been modeling out. But we do see a decrease back to 10% and then an increase to 18%. So that's not like conservative. This is weird. This is also Apple Watch revenue. All right, but let me build out the other parts of the revenue first. So we so far have done iPhone, iPad, Mac, Apple Watch, and then there's accessories, and then services and other products. Yeah, there's so much more to build out still. Okay, so for these next three, we thankfully don't have to yeah, so I see a comment here that we can just use a street case, combine the three. That is a good point. Rather than making everything, yeah, maybe for the next model, when maybe if I update this current one or something, we can actually sensitize for everything. But honestly, I'm getting pretty tired. It's pretty late here in Korea. So let's see what this comes out to. Although for services, it is actually important to see what. So I think what I'll do is I'll combine accessories and other products. The services, we're gonna actually, that's a huge driver for Apple. All right, so accessories and other products in 2015. And I see a question, can I upload the stream? All my streams would be, all my streams are going to be uploaded, so no need to worry about that. Okay, accessories and other products. Let's move that. Let me know what you guys think in the comments though. Do you guys think that Apple is going to be a buy or a sell? Not just based off this DCF, but just like in your own personal opinion. Do you think Apple is a buy or a sell? Okay. I see a few buys and one sell. Okay, so accessories plus other products. Man, these numbers are so weird. Okay, we're gonna need to use a Kager. So let's try to get this correct. %20. No, but I don't think it's gonna stay at around 20%. But so see what's driving these figures. Oh, the growth is really happening because other products just came about in 2020 and 2021. So, and these numbers have been steadily growing for accessories. It's really just these years we should kind of be looking at. Oh man, what to do here? Interesting that declined. Oh wait. Oh, why is this? Oh, it's much better. I guess Apple, maybe they recategorized how they're doing this. Sorry. I think they recategorized how they break this out, because it just kind of seems like to me maybe they had accessories only and then now they have this other products thing. I'm not really sure, but either way, let's see what the growth rate is. Interesting. Okay, so the street has it at 20. Okay, so 3% and then 8%. So it's going to accelerate. Kind of odd. And then we also need that for services later. Okay, so accelerating growth. That's pretty weird. Okay. All right. I have no idea what's going to happen with accessories and other products. And it's not a huge revenue driver, so I'm just going to take an average of the past of these 2 years here. I think that's a little conservative. Everything in this model so far has been pretty conservative, so I think my guess would be that right now, and Apple's going to come out a little overvalued, but we might have to just look at our optimistic case and then see what numbers come about from the optimistic case. Okay, so conservative case. Now these are, this has all been growing pretty steadily for Apple, and I think part of this might have to do with the AirPods, which I think are like a great product and will continue to sell well. So I actually think, I don't know why the street is not really deciding to grow it by much, but I actually think we should keep it at 8%, because that's such a big decline from this 37% growth rate. Hmm. Oh, I also have a feeling that the analysts just have different figures, and so it's bringing down the average. It's not very clean, but we'll see what our total revenue figure comes out to. Okay, so that'll be 8%. I think, I guess here for conservative case, this is bothering me a little bit that this number is so low. I guess it'll have to be something like 5%, and then in optimistic, it'll be something like 11%. At this point, I think I don't think this is like the cleanest, but need to finish off this revenue build, and this is not going to be the largest driver. Holy crap, where are these spammers coming from? Sorry, there was something in the chat I had to get rid of. All right, guys, we're almost there. Services, 2022 growth, 16%. All right, so this is one of the largest growth drivers for Apple. And for this, I'm just going to assume average over the past 2 years. Since we're only projecting out for a few years. Actually, this should be kind of going downwards because this number is pretty big now. So we'll assume that in 2026, it falls down to something like 8%. Seems to make sense here. And we're going to linearly just grow this down. Oops. Oops. Okay, and then use the street assumptions here. Double check something. Okay. And then for our conservative case, we'll just do like a 80% haircut, and then optimistic case, we'll have a 120% increase. Okay. It should be linked to the accessories one. All right. Okay, we finally built out revenue. Wow. Okay, so let's start adding everything together. Oh man, that took forever. So we have our iPhone revenue plus our iPad plus Mac, plus Apple Watch, plus accessories, and then plus our services. Then we have our growth rate that we need to calculate. Okay, so we have a 6% grower in Apple, and then drops by 2% mainly because of their their iPhone sales decrease, and then it kind of grows back up. These numbers are actually pretty reasonable in my opinion. Let me just double check one thing though. 2015 revenue. these numbers should be pretty close. So it's okay that they're not 100% accurate, or actually, I mean, it should be if we were building out like this model for like if we worked at a hedge fund or something. But we're using a wide variety of different figures to get our revenue, right? So in an ideal case, actually, we should be getting these like exact figures, but since these are historicals anyway, we're not necessarily like going to use them for our projections. I think it's kind of fine. What actually is a little bit more important is that our estimate, or is that our since we're using the street case for here, everything aligns more closely with what the street thinks for total revenue, and we are pretty meaningfully more conservative because I think mainly due to the iPhone issue, and then a lot of like other parts where we previously discussed is a lot more conservative. Let me see what the total optimistic case looks like though. Okay, our total optimistic case is a little bit more similar to what the street thinks is going to happen. Okay. I feel okay with my assumptions though, to be honest. I think if anything, it seems like the street might be a little bit too optimistic. And this follow like right now, what we have here in our complete base case is similar to the pattern that we have seen kind of for Apple, although they did see this huge revenue increase. So maybe I'll change. Let's see. Maybe this is a bit too aggressive. So instead of taking the average here, we'll make this something like negative 5%. Make this a little bit more severe. Let's see how that changes things up. Okay, that makes our optimistic case a lot more closer to the street. And I think that is what I want, because I want in a super optimistic case. Wait, I see in accessories, did I only link to accessories? No, so I added the two together, so this should be correct. Thanks for checking on that though. So I think what's good here is that our model is a little bit more on the conservative side, and I do think that my numbers, if the estimates provided here are accurate, then I think having everything a little bit more conservative on the base case is good. And then, but you know, I can also check when I get my implied share price. I can make everything more optimistic, and then see what happens. And then we'll have like a good range. I think my range will be in between base case 2 and 3 instead of this conservative case, it's good to have, like, if things change and like a recession happens, right, then you can always like change everything to make it conservative, and you have that flexibility with your model. But in our case, I'm going to mainly be when we get to our implied share price, I'm going to be focusing on the base and optimistic cases. All right, so now we have this, which is the most important part. And now we actually have to calendarize. So just to kind of go over what we have left in this model here. So we finished out the revenue build. And then for DCF, we have calendarization, WACC, and mid-year convention. So all of this shouldn't take too long. But anyway, now it's time to actually build out the DCF. And we'll do something you guys probably have seen in the past in my previous modeling videos. Okay, but we are probably, so we're about 2 hours in. We're gonna probably take another hour or so to finish. And before I do start the DCF, oh, actually I need to do calendarization first. So actually I think we just can start with the income statement here. Okay. So before I move, actually, sorry, I'm being indecisive. Okay, so we need our revenue, then we have a percent growth. Then we're gonna need our EBIT, and then our percentage of sales. Check what time it is actually. Okay, so we have percentage growth, percentage of sales, and then we're gonna need our taxes. Make this a percentage of EBIT. So this is our numbers that we have here. And then EBIT we'll find in our income statement. So 2015 operating income. And have this be a percentage of sales. I see a question, how much is FactSet? It's around a little over 1,000 a month. So operating, and then taxes, tax expense 2015. Percentage of EBIT. Okay, so nothing too crazy so far. These 2024, 2025 figures may not be super accurate though. Let's just double check. Yeah, 2024, a lot of people drop off. So these figures are not going to be super accurate. Just make a note of that there. And then, so we have our income statement line items. Then we need our cash flow line items. So for that, we're going to need our DNA. This will be a percentage of sales. And then our CapEx, that'll be percentage of sales. And then our change in net working capital, percentage of sales. So DNA, here 2015. CapEx 2015. This percentage of sales as well. Change in net working capital. In 2015. Okay. We actually don't have estimates for this, but that's fine because it's not really a huge part of our model. All right, so numbers are looking pretty good so far. The only other thing I want to check here is percentage of CapEx, because these two should trend towards one another, which it looks like it's doing, which is exactly what we want to see. I actually see higher DNA than CapEx, which is not exactly sure why that's happening, but and then percent of change in sales. So that's just to see which one we should use, and it looks like our change in networking sales is going to be a lot easier to use. Okay, so now we finally have our line items that we need for the DCF. But one other thing that I need to do and wanted to show you guys is calendarization, and I've done this in I think the NVIDIA DCF, but we're going to need to do this for Apple because they end on a September 31st fiscal year end, right? So let me just make a note of that here so it's really crystal clear. So they end on 9/30 fiscal year end, and we need to calendarize to make it December, right? So what we want to do here, so I'm just gonna have these little cells here, I guess, to just kind of indicate. So we're gonna need 25% of the previous year and 75% of the current year. So what I mean by that is this should have 9/30 on it. I'm also surprised that there's still 88 of you guys on here. I think it's been around 88 this whole time. It's been a little bit higher from time to time, but this has been going on. This DCF has been we're 2 hours in already, and we have about an hour left before everything finishes, I think. Anyway, so in 2015, this is basically giving us until the September 30th of 2015, right? So for example, if I were to go to you can see their fiscal year ends on September, right? So that's 3/4 of the year. So what we need to do to get to a true calendar year end 2015 number is we need to take, let me switch these actually. We're going to need to take 75% of this year, multiply that by 75%, and then we need to take 25% of the next year, and then multiply that by 25%. So this is known as calendarization. Basically, you're just converting everything from a September fiscal year end to a December year. And let's say like Apple had a June one, right? Then it would just be 50%, 50%. So that's what we're doing here. And so let's see, 20, let me just double check to make sure I'm doing everything correctly. So yeah, this ends September, we need a quarter from there. So yep, that's correct. And then we can just multiply this across. The only issue what I'm seeing here now is that we actually need it until 2027. What can we do here? Yeah, I see a good question about, is it fair to assume linear revenue when you calendarize? So nothing that we've done so far is really super linear, but I think what the question is like, can you just assume that it's, the each quarter is worth the same amount in a sense, right? So because we're taking a quarter here. That's like a really good question. And I also realized this is for DNA. So I'll fix this in a bit. But for the DCF, it's just like a simplifying thing that it's okay, because it's gonna give you a roughly like good approximation of your DCF in a sense. And the reason that we do want to calendarize is that when you're looking at a DCF, usually you want to do things on a December year end, because it's just easier to kind of like think about when your cash flows are coming in, but by looking at December year ends. I'll show you guys what I mean when we do your mid-year convention and everything though. Okay. All right. Days matter a little bit, but I think for our purposes, we're not going to worry about it. Okay, so I'm thinking about what to do here because we do need one more year of projections. It's kind of, let's think here. 2015. Hmm. I think if I were to copy paste this across, it should pretty much work, because I have to double check everything, which I'll do right now, but we're kind of using this, we're keeping things flat for a lot. So far iPhone is fine. So question, if you're doing unlevered or levered free cash flow for DCF, you almost always want to do levered, so that's what we're doing. Or sorry, unlevered. Okay, so good thing about the way we built out the model so far is that everything is kind of just staying flat, right? So we should be able to just create this additional year. I guess this is the only other thing. The only thing we need to change here is that this okay, cool. All right, so now we're ready to calendarize after I fixed a few things. So we only really actually needed it for revenue. Wait, why is this being weird? Oh wait, we don't need our 6 years of projections. Okay, so because we're doing a 5-year DCF. All right, so now we can calculate growth. And then we can do the same thing that we did for our EBIT. And you can see that I just copy paste this. And since the spacing is the same, I can actually just copy paste this across. And I want to keep in mind which ones are super not like entirely accurate to use. So that looks like it might be starting 2023. Most of it is accurate, but just slightly some of it is not super accurate. So I see a question about difference between the 5-year and 10-year DCF, and mainly it's about confidence of being able to project. And yeah, so if you can project out 10 years and you're very confident about your projections, then that's fine. And but ideally, yeah. And then the other thing is if it's a kind of like a startup company and there's cash that is going to be generated a lot later down the line, then that's when you would probably want to use a 10-year DCF. Versus if it's like a very stable company like Apple, then you probably just want to use like a 5-year DCF, which is what we're doing. Okay, we're almost there. Probably not gonna make the model super or the DCF. I don't think I'm gonna make cases for the cash flow items. I don't think we need to. So the rest of this hopefully will be pretty quick. Oh, just realized on the stream you can see the sunlight now here. Okay. So we'll have percentage of CapEx just for reference, but not going to use it. This will have a percentage of sales. But we're not going to use this either. All right, we finally have what we need to build the DCF. Oh wow, that took forever. Okay. So we're gonna build out the DCF now. Before I do, because it's been so long and I know a lot of people probably missed the beginning, I do need to do a friendly reminder of today's sponsor, which is Wall Street Prep. And they pretty much, I'll go through it for just a little bit, but they've been around since 2004 and they train a lot of the analysts at a lot of the banks. And what they really specialize are in like online courses. So they have a ton of financial modeling courses, and the discount here, if you use my code RareLiquid, you get 25% off of any course. And they have a lot of different courses you can use to just get better at modeling. And there's a ton of detail inside here. So for example, the accounting course, which I recommend for people who don't have like a finance background, there's 54 lessons, 7 hours worth of lessons, and there's 100,000 students who've used it so far or done this course so far. And then this financial modeling package is the most popular one. And there's 46 hours worth of courses, 100,000 students who have kind of taken the course, and you learn financial statement modeling, DCF, M&A, trading comps, transaction comps, LBO. So everything you really need to know as like a potential banker, or if just you're interested in modeling. So feel free to check them out using my link down in the description. So yeah, just wanted to give them another shout out for sponsoring this video. And now we are ready to build out our DCF. So we're going to have revenue and percent growth again, just as reference. We're going to have, all this really, to be honest. And the only thing we're going to sensitize on here is our EBIT, because taxes seems like it's going to be pretty steady and flat. Even our EBIT margins, it's going to be pretty flat, but we do want to make that sensitized. And then our D&A, CapEx, and change in net working capital also looks like it's going to be pretty steady. So the only thing we really need to make flexible is our EBIT here. Okay, so revenue have up here. Gonna make this purple, since purple indicates it's coming from the same cell or same sheet. And then for our EBIT, let's also grab that as well. Okay, so our street in our EBIT, our street thinks that going to be 31% and then kind of stay flat pretty much. So I think what makes most sense here is to just keep everything flat. So instead of kind of going with what the street thinks of like this slight decline and then increase, keeping everything flat is like, I think, a more reasonable assumption. I'm going to hide these rows for now so that we can more quickly get to our assumptions. So this was here, so we're going to keep things flat for our base case. And then for our 2022 figure, we're going to keep it the same because, as I've explained in the past, 2022 figures are going to be pretty accurate. And then for 2023 onwards, I think we can just linearly grow this. Like, Apple is going to do its absolute best to maintain its profitability because that's just what they are focused on now. They're trying to be as profitable as they can because the units of what they sell may not really be increasing that much since they've saturated a lot of the markets that they're in. So I think if we were to be conservative, this could grow, like, I don't think this would happen, but if it were to grow down to 29%, and then in an optimistic scenario, it would grow up to 33%. So that's what we'll do here. Oops. Okay, so this is linearly growing down, and then we want this to linearly grow up. Let me move this around. I think this should be right. Nope. Okay, so L158 plus the difference between P minus P. Oh, oops. Okay, there we go. All right, so then use our offset formula. Go to our switch. All right, so now we have our EBIT, so we're good on that. Taxes. Taxes are up here for historical. And looks like taxes are around 14% here, 16% in the future. So I'm just going to use a simplifying assumption and then use the average of the past 3 years. It's around 15%. I think that's fine. All right, so then that's our EBIT times percentage of EBIT to get to our taxes. That gets us to our EBIT, which is our earnings before interest and after taxes. That's really simply your EBIT minus your taxes. And then now we have our cash flow items, which is our D&A, CapEx, and change in net working capital. And the great thing about Apple, as I've mentioned, is that these numbers are very steady. So we don't need to worry too much about making everything like, or sensitizing for anything like we have had for previous DCFs I built on this channel. So what we're going to do here, given that Street thinks it's around 3%, I think we can just keep it similar. And then for CapEx, do something similar here. See if I can copy paste this across. Nope. Okay, so let's see. 11. I'm just seeing if these are similar to the Street, and I guess it's a little bit higher, but that's also because we're in our optimistic case scenario. These two should pretty much cancel each other out, so I think it's fine. Then percentage of sales, or sorry, change in net working capital. Okay, I think what we can do here is take an average over the past 3 years, given that things have been going up and down a little bit. And it looks like that's going to make things slightly on the decline, but not a huge part of analysis in general. Okay, so as you guys can see, the DCF part was not really too bad. It was really everything else that led to this point. So our free cash flow is our EBOT plus our DNA minus our change in minus our capital minus our change in net working capital. Right? So now we have our free cash flow, and we're going to need to get our present value of free cash flow. And we also need to do something called mid-year convention. So what mid-year convention does is so this goes to like our beginning where talked about what we're going to do for the DCF. We need to do a WACC calculation, and then I wanted to also show you guys mid-year convention. So all right, mid-year convention, essentially what it does is it, instead of having your cash come at the end of the year, it allows you to grab assume that your cash comes in the middle of the year. So instead of December at the end of the year, it'd be the June of the year. And to be quite honest, I haven't done this in a while, but let me try to remember how to do everything. It's not too complicated. So today's date is, so the other thing I want to show you guys is or actually let's just do this. So we're gonna have to basically calculate our periods. So what this means is currently right now, so I'm going to take a bit of a shortcut. So currently our date is July 29th, 2022, right? So I'm going to take the last year, or the amount of, or December 31st, 2022, and then subtract that to get to, actually that doesn't work. Let's see if this works. So that pretty much gets us the number of days that we have. Okay, that didn't work either. Okay, so how do you figure out how many days we have left in this year? Man, there was a formula for this, but I forgot. This is definitely not what I used. Oh, I see year frac. That actually sounds familiar. I think that might be right. So start date is here, and then the end date is 12/31/22. 5/1. Doesn't look right. Okay, I forgot, but let's see. We have August, September, October, November, December. Oh wait, I see a tip, format as general. Ooh, thank you. Awesome. Okay, so we have 123 days left. in the year. And if we divide this by 365, we have 34% of the year left, basically. So what we need to do here is we can only really take 34. What this is saying was we can only really take 34% of this year left for our free cash flow, for this to all be like accurate and stuff. And so what we want to do is for our period, so let's just call this like year one, and then we have like these next 5 years. The what amount that we want to really discount is actually that times this, right? So we want to discount only by, let me remember how to do this actually. The period we want to discount for this is only with 34%, and then for the rest of the years, we want it to be 0.5 plus this 34, or 1 plus, this first year is 34% left. So then the mid-year convention would be this divided by 2. Is that right? Yeah, we want to only discount it back by that. And then for the following years, we want it to be in the half. So we want it to be June of 2023, which is that plus 0. And that plus 1. So what this is basically doing is for this year in 2022, we're only discounting back by 0.17. So this is half of the remaining year, right? And then for the year of 2023, what this number is aiming to do is discount us back by up until the date of June 30th, 2022. And from today, July 29th, 2022, if we were to use this formula again, then this is for July 2023. So I know this might be super confusing for a lot of you guys. This is the first time seeing it, but hopefully if you guys can replay this would make sense in the future, or replay this as you guys watch this again or something. But what this is saying is that, all right, let me do one more thing to explain this. Okay, so to explain what this 0.84 means is, if you watch my previous DCF videos, you've watched me just get our cash flow figure divided by 1 plus our WACC. So we need to calculate WACC, but let's say it's like 10%. And then we would go to the power of the year that we're in, right? And that would assume that we're getting all this cash by the end of year 1. But there's actually 34% of this current year in 2022 left, right? And what mid-year convention is we want to assume that we're not getting our cash at the end of the year. So that which would be, in this case, discounting back by 0.34, we want to get it by the half of the end of this year, which is like October-ish. So that's 0.17. So instead of discounting back by 1, we would discount back by 0.17 for the year of 2022. And then for the year of 2023 and onwards, we want to have the discount period be in the middle of each year. So we want this to represent June 2023. And that's what we're doing here. So what we've done is I've gotten here the end of the year, which is December 2022. And then I've added 0.5, which 0.5 is 0.5 of a year. So that gets us to June 2023. And So let's see. Yeah, so that's pretty much what I've done here, but let me just double check everything. C5. So I see here, would year 2022 be year 0 as its current year, no discounting needed? No, because there's still some months left in 2022, right? So any cash flow you get in the future, you need to discount back to present value, whether it's a few months or a few days. I'm just trying to think why these numbers are not necessarily lining up. 122 days left. That's 34% of a year. Oh, okay, it's because we were adding 0.5. Okay, so that's why they wouldn't add up. Okay, so anyway, sorry, I was just double checking something there. So this is gonna all look a little bit wonky if it's the first time you're seeing it. But the point is that this should be kind of like an assumption almost. And then these are calculations. This we don't need. Actually, we do need. This is our discount period calculations. I'll just move this over here. All right, so now we have our discount period calculations, first year, discount years, and then we now need our WACC and terminal value. So that is what we will do now. And I'm going to do this pretty quickly because we're almost at 3 hours. So our WACC equals our percentage of equity times our cost of equity plus our percentage of debt times our cost of debt times 1 minus your tax rate. And cost of equity, just as a reminder in case you guys, I do have a DCF tutorial video down below if you want to take a look at that. But risk-free rate plus beta times your market risk premium. And I'm going to actually steal from the Microsoft DCF that I did recently. Get all the formatting. Okay. Okay, so market cap of Apple today. See what that is. My Apple stock. Actually, let's get it from FactSet. Almost done, guys. Okay, so market cap 2.54 trillion. Risk-free rate, so I got this in the past, but risk-free rate is easier. You can just look at your 10-year treasury yield. And so this is currently at 2.658%. beta is how volatile your stock is compared to the market. And for Apple, it should not be a high beta. Doesn't change that much. 1.27. Market risk premium is what the is your rate of market return minus your risk-free rate, and that you can look up Professor Damodaran equity risk premium, and if you go to equity risk premiums, actually no, it's not that. And I always forget where he puts it. Here it is. So these are equity risk premiums. If you just look up United States, it's that's where we get the 4.24%. Okay, so cost of equity is your risk-free rate plus your beta times your equity risk premium. And then debt, we need to get from, we need to pull from the financial statements. So let's see how much debt Apple has. So commercial paper, term debt. So equals that plus that. And then long-term debt. So Apple has 2.5 trillion in market cap and then $120 billion in debt. And for percent, here, let me do a few more things. So the total here, so for percentage of equity and percentage of debt, that's really simply just your market cap divided by your total, and then your percentage of that time divided by your total. And you can see that we're pretty much going to get most of our WACC from our cost of equity. So it's going to be like 95% of our cost of equity. And then cost of debt is really just like the interest rate that Apple gets charged. We just need to look up, find what their interest rates are. I think they were at the cover actually. So it's like anywhere from 1% to like 2%. It's nice to usually have a weighted average. I'm not sure if we're going to have that. I have to look at their 10K. Okay, so we have interest rates here, effective interest rate. So normally it'd be good to do a calculation, but not really feeling like I want to do that. So it looks like it's at most something like 1 point something percent. I actually think there was a equity research report I was looking at that had this calculation maybe. Let me check. Here it is. Cost of debt 3.9% for Apple. Interesting. That's kind of high. So let's just steal from Morgan Stanley, reputable bank. Okay, and then tax rate, we'll just steal from here. And so our WACC is our cost of equity times our percentage of equity, or percentage of equity times cost of equity, plus our percentage of debt times cost of debt times 1 minus the tax rate. So 7.83%, kind of higher than what Morgan Stanley thinks, but still not that high of a WACC. Anyway, that all just leads to here, where we just need to build a few more assumptions with our WACC and then our terminal growth rate. Then we are home free. Okay, so we have our WACC switches here. Okay, so we have our switch. Our base case, we're gonna just use our WACC here. And then for our conservative case, when we get a higher WACC of 0.5, increase it by 0.5%. And then for a lower WACC, we'll decrease it by 0.5%. And the reason we are a lower WACC is more optimistic is because it means you're discounting less. So if you're not sure what that means, then you'll probably need to brush up on what a DCF is and stuff. I'm too tired to explain right now what that means. But I am actually planning to make a very, very long tutorial on how to build like a DCF, like a much longer than the one I have right now, which is like 30 minutes or so. So be on the lookout for that. So, okay, now we're going to get our WACC. All right, so we're going to name this WACC. We're going to name this term in TGR. Sorry, and I know I'm breezing past all of this, but just trying to get done with this as soon as possible. So now we have our free cash flow, and then we have our periods. So what we're going to do here is get our free cash flow divided by 1 plus our WACC to the discount period that we need it for. Okay, so, and then do that for the next following few years. All right, and this is our free cash flow calculation, and it looks like most of our value for the Apple is actually going to come in the terminal value. And then that'll eventually get us to our enterprise value. Then we need to add cash. Then subtract debt. That gets us to our equity value. And then we need our share count. And then that gets us to our implied share price. Ooh, we're gonna finish this right before 30 minutes, or 3 hours. Okay, so our free terminal value is our last year's free cash flow times 1 plus your terminal growth rate. It's all divided by our WACC minus our terminal growth rate. Hmm. 3 trillion. Are we in our we're not optimistic case right now. So I'm gonna make everything our base case right now. Present value is 1 plus our WACC to the power of the year. Okay, so our enterprise value finally made it, is our present value of our free cash flow and our terminal value. And we got to add cash, which we need from our most recent 10Q. Get cash and cash equivalents. And then also add marketable securities. Debt we had in our WACC here. The equity value is our enterprise value plus our cash minus our debt. And then our share count is 16 million. Actually, we need our fully diluted share count. That's here. All right, finally. So that implies Apple share price of 132.82. After 3 hours, this is what we've been working towards this whole time. But that is not exactly what, I think Apple's share price is going to be based, or should be based on like our calculations. We'd have to like play around with these assumptions here, right? So first off, we have implied share price. And then we have Apple's current share price. So Apple currently at 162.51. So implied upside or downside. All right, so I know this looks bad now, but let me explain why it's not. Or as in bad as in like Apple looks overvalued, but I don't actually think that's the case, because that's not what I believe is. I don't fully believe, or there are some things that we need to adjust. So as we kind of like went through, if you started looking at this model with me from the very beginning, you'll remember that a lot of our assumptions are less than what the street thinks is going to happen. So for example, Apple, for iPhones, the street thinks that these red figures are what the street thinks that Apple will earn in terms of iPhone revenue, and we're kind of meaningfully under it. And that this actually has implications in their future. So the street doesn't project out for 2025 onwards, but if this was at 217 billion, then this would go to like if it grows by a little bit, it would grow by to like 220 billion or something, right? And that actually has large implications to our revenue. And so for every single kind of revenue part that we built, so iPads also we did a little bit less, Mac also a little bit less, and then Apple Watch also a little bit less, right? And the reason for that is because we were using the assumptions that we had from the street. I won't go into everything now, but basically, like, I think it's always good to have a bit more of a conservative DCF, even if it's like your base case scenario. And I think that even with something like the iPhone, in our current base case scenario, we're assuming that Apple reaches higher than it's ever sold in the past and dips a little bit, but kind of is able to get back steady to like the previous peak, right? So I don't think this is super conservative at all. So I think the street may just be a little bit more aggressive. But what I basically think here is that if I think it's fine to look at the more optimistic scenario. So except our EBIT, we'll keep it the same. Terminal growth rate and WACC, we'll keep it there. So I guess what this implies is if we were to have just our revenue be more in line with what the street thinks, then right now Apple's implied share price is around 143. If we were to think that they're able to grow their EBIT, so basically like pure optimistic scenario, Apple would be at like 185. So I guess what I'm trying to say is that the range of where I see Apple's fair value is somewhere between here. So base case, pure base case is 132.82, and then optimistic case, which is 185.52, right? So, and then if we were to take an average of these, that's kind of where Apple is trading today. Now, so if it's in between these two things, I do think that Apple, let me think here. What is this all saying? I think Apple is fairly priced at where it's currently at. So it's at 160. It has fallen quite meaningfully from where it was in the past, right? So the 52-week high of Apple, where is that thing? I guess it's faster if I look over here. Previous 52-week high for Apple was 182.94. And so my pure optimistic case gets us back to that, right? And that's before like we had all these like macroeconomic issues, and you could argue that a lot of stocks were overvalued when they were at their peaks most recently. So what does this all lead? What does this all mean? I think based on doing all this work, I'm not a huge buyer of Apple at this price. Like I think if you were to buy it, you probably wouldn't lose a lot of money, but you probably also wouldn't earn a lot of money. So why not just buy the S&P 500 or the NASDAQ, which is a lot more diversified, instead of Apple if you don't have like a huge upside potential? That's just my opinion. Doesn't mean Apple's a bad company or anything. What this also means is that if we do get like into a big recession or something, and then Apple falls down to somewhere around the 130s or lower, that would be like a very good time to buy Apple in my view. So anything below 130 is like an ideal time if a recession happens, etc. I think Apple will bounce back eventually, but at its current price right now, I feel like it's more of a hold rather than a buy in my view. So those are my thoughts on Apple. It's been around 3 hours now, and I gotta go to sleep. But thank you all for tuning in, and if you did watch everything from beginning to end, then huge props to you, because this was a beast to get through. And I wanted to give another friendly reminder, if you guys forgot since this stream took so long, if you want to check out Wall Street Prep, who they have like a ton of financial modeling courses you can check out. Use my code RareLiquid to get 20% off. I also have a bunch of stuff on rareliquidcareers.com if you're interested in banking or MBA, because I'm currently going to Wharton for my MBA. I'm on a 2-week break right now, actually. So you can buy some of my applications. You can buy like some guides I've created, resume, cover letter that got me into JP Morgan, all this stuff. Feel free to check that out. And lastly, I am building out my own how to get into banking course, and that is also linked to as a Google form down in the description below. So feel free to check all that out. Thank you all so much for joining and watching. Hope to catch you all in the next video. Thanks guys, and peace out.